Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. It'll be related mainly to three topics: commodities, wealth building, and or financial topics. So let's dive in here. Let's see what people are talking about, what they're sharing on social media. If you want to follow me, it's at Funny_Finance. And if you want to join our community, finding-value.com, that's where we go over individual companies. We do question and answer sessions to help members. And we also cover a wide array of potential investments that are undervalued. I'm really digging for value in those. So let's dive down. Let's see what's going on. The second inflationary wave is coming. This chart shows lumber, and I know some people use lumber as a leading indicator. Having backtested huge support third time, this time with increasing volatility gathering energy. The push narrative is inflation is done. No, it is not. Not by a mile, unfortunately, says Grady. This is lumber monthly candlesticks on a 15-year trend line moving back and forth. You can also see the MACD starting to move on up. It is in negative territory, but it's going to move on up. And positive, strong divergence in the stochastics. One thing I'm going to say here is some of these, people use this as an indicator. And what it is an indicator for is the housing market. It's if you've got a stable supply of something and lumber prices start to increase, it means that your demand is starting to outstrip supply. But if you look back at 2020, we had a volatile move. And I think a part of that signal is not as pure or as strong and as smooth as other cycles. They shut it down, all these lumber mills. We had a huge spike with a bunch of money creation coming into the system. We had the supply side shut down and prices spiked. So you can't say that in 2020, 2021, and the move lower, which is a normalization of the price of lumber, you can't say we had a housing boom in 2020, 2021 because you shut down supply. And then you can't say that we had a housing crash in 2022 because the price normalized from that shock of money creation, lumber mills coming back online, et cetera, et cetera. And that's what I meant by your signal was lost as an indicator for those couple of years as you had the shock and then the come back on. And people were, I was seeing people online, they're like, oh, housing's going to crash. Lumber's crashing. It's like, God, you guys are dense. Like, you can't use a signal when you completely blew the signal up in 2020. But now, since I think it's stabilized, if you have stable supply and then you have a demand that starts to outstrip it, you might be able to use it. Now, we still might be too early for this to all be kind of relaxed to a level. So what I would do is just go straight to the housing starts. Go straight to the housing starts, look at what they're doing. If the housing starts are stable, then you start to look at new home sales. And then you look at home sales in its entirety. Because really, lumber is a derivative of what we're looking at. The leading indicator of what we really want to know is how much money is coming into the system through bank lending. So you want to look at bank lending, you want to look at housing starts, and you want to look at home sales. Those three combined are your leading indicators. Lumber is a lagging indicator because lumber is what is going to be purchased after those go up. In OOT, it says Saudi Arabia will no longer target a 13 million barrel per day capacity and will stick to 12 million, official statement. It's probably because they've got old fields and they are being depleted. I don't even know. I mean, we'll see, but 12 might be tough for them at some point to do in the future here. In a bear market, these tables are full of red. In bull markets, there's historically a lot more green. It's just math. You don't have to like it. And this is the major indices and their moving averages. And this is the S&P 500 at the top. There we go. NASDAQ Composite, New York Stock Exchange Composite, Russell, Dow Jones, Russell 2000, Value Line, Geometric. They are all above 250-day, 200, 150, 100, 50, 20, 10, and 5-day moving averages. They're above all of them in these moving averages and the indexes historically to them, the indices. We've got JC Parrots. If it's only technology that is driving the market higher, then why are all the biggest bellwethers in both industrials and financials also making new all-time highs? And he's showing Caterpillar. Now, Caterpillar, that's actually, I think, a pretty good bet. I think we have to build a lot more. Let me zoom that out, zoom in. We have to build a lot more mines. And what do they build? Equipment for mining. They build a lot of stuff for the industrial sector. And then JP Morgan Chase, yeah, that's a financial. So we're seeing the breadth also participate in this move higher. And again, guys, I'll just say this. I think it is being driven by debt, by money creation, by fiscal spending. I mean, I think they're just going in there and just bazooking, however you say it. They're just shooting money everywhere. And it's the money's going all over the place. That's what they're doing. BNN Vinicor says once companies are finished with paying down debt, the money needs to go somewhere. Buybacks and dividend increases. There is seasonal strength for energy stocks. And here's the seasonal strength for WTI crude oil futures seasonality. It is most strong from February, middle of February, all the way through June, end of June, beginning of July. Then we do kind of a double top, and then we move lower after October. And then we start the cycle again in February. So we do have seasonality right in front of us, generally speaking, for strength in crude oil. That was over the past 20 years, you guys want to know. Here's one. It says, breaking news, as early as tonight, President Joe Biden will authorize U.S. military action in Middle East. Now, generally speaking, when we go to war, if there's military action, oil goes up and so does gold. And this guy says, doubt it. If true, watch oil sell off to $69. There is zero geopolitical tension in the oil price at this time. There is literally zero. How do I know that? If you look at where oil is priced in relationship to our inventory level in commercial inventories, we should be trading right around $78. We are actually below $78, and that's the fair value if you look historically with pricing and where commercial inventories are at. So there's zero geopolitical pricing in the price of oil at this moment. We are very low inventory-wise. We've been drawing inventories down. So the momentum is for oil prices to go up, not down, from an inventory level worldwide. And I find it highly weird that there is zero geopolitical pricing in the price. I also find it weird that we've got ultra low sentiment in oil. So it's actually a very good setup for someone who wants to take a asymmetric bet without geopolitical tension. And then if geopolitical tension does come and the money comes rolling back in to reprice it, I think we could be trading $100 to $120 a barrel easily by end of summer. If geopolitical tension comes in and we get the seasonality to kick in and sentiment starts to turn, it's possible. Now, I'm not stating that's not my case or my prediction, but if geopolitical tensions, if they come up, and we continue to drain on inventory, you could easily hit 100, 120. Gas-fired power sector booming like there's no tomorrow. 134 gigawatts of gas-fired power capacity are currently under construction worldwide. Gas-fired power stations currently under construction worldwide, sized by mega or by capacity, and we've got a lot all over the place for gas-powered power generation going on all over the place. Look at that red here, Jesus. AI infrastructure, energy, uranium, and precious metals, everyone is piling into the obvious, not the road less traveled. So what does he mean by this? Let's go through this. AI also uses more energy than other forms of computing, a crucial consideration as the world seeks to build a more efficient energy system. Training a single model uses more electricity than 100 US homes consume in an entire year. In 2022, Google reported that machine learning accounted for about 15% of its total energy use over the prior 3 years. However, data is not systematically collected on AI's energy use and wider environmental impacts, and there is a need for greater transparency and tracking, especially as models grow. The most efficient computing infrastructure and AI algorithms should be prioritized to prevent it from offsetting efficiency gains. So AI is just an energy hog. It's going to look for a ton of energy. And, this is at a time where nuclear, uranium specifically, the inventory is getting pretty tight. So if this thing is consuming this amount of energy, well, where's the energy going to come over the next 5 to 10 years? The growth of energy. We also need to really kick up our grid if we're going to be sucking down this much energy. And if we've got electric vehicles on top of this getting piled onto the grid, man, we need to really start moving. We have a lot more electricity to generate, guys. As the U.S. prepares to strike Iran tonight, let's go short oil. Imagine this coming up in New Ideas meetings. As the Middle East falls apart, the largest net short position in WTI oil since 2016. Well, I don't understand it, guys. Why would you be shorting oil here if we've got a potential war? It's weird. Update the best new construction channel. Check out the block is hot. It says land prices reflating eventually will erode builder margins. Duration of land banks going to start mattering much more. Actually, pretty negative. Leonard Corp. BLDR doesn't mess with land. So we're seeing that the land market hotness and pricing jump year over year. Several home builders report this week and will likely get more confirmation of quickly strengthening land market. It's because we're in a expansion phase of real estate, and we're seeing prices start to jump. Now here's crack spreads. Crack continuing to improve. 211 is just shy of $30 a barrel, and that means that refiners are going to make more money as their spreads increase. Just an FYI. The Wall Street Journal this morning, people who are bad at math and serial liars have all been telling you that it's only US tech that is above their former highs in 2021. This is one of many charts they won't show you because it proves how full of crap they are. And this is the Europe Stocks 50 Index, 20-year high, and it's breaking out of a cup and handle. I have a feeling we are going to run in everything. And I also have a feeling that it's going to be due to inflation. Lots of inflation's coming, guys. Lots of inflation. Does home ownership create wealth? Absolutely. Just saying. So every 3 years, they've got a renter net worth, then they've got a homeowner's net worth, and they're probably including the price move of the home that they are living in. And that's the net worth is widening. They're also probably increasing investments with the homeowner because if you buy back here, your mortgage is basically on a 30-year fixed or a 15-year fixed mortgage rate, and the renter is paying larger and larger sums of money to rent. I know renting here, it is far more expensive than what my mortgage is, way more. And that is one tool I'm using to lock in my costs over time. So home sales are growing over the last year. Can it continue? Question mark. NAR last week released their pending home sales data for December, confirming the Altos data has been sharing. In fact, the total number of single-family homes with sales contracts pending is 5% more than last year. So home sales, 5% more than last year, 276,000 single-family home contracts. So that's going up for contracts pending. We've got inventory for sale basically flat from the year before. We've got median home list price. We've got 424. Last year was 400,000. And then we've got median price of homes in contract. You can see it's moving up and it's higher than the years before. So that's what we've got in housing. Housing looks strong. It says small pullback in uranium futures pricing. So there's the move on a longer picture view. There's the pullback that we're seeing. People are probably like, oh my gosh, we have a pullback in uranium. It's time to sell. No, no, no. I'm still bullish, guys. Just ride this thing. We're going to get pullbacks as we go. If the biggest and best uranium producers in the world are facing a myriad of issues ramping up production, what do you think the smaller producers and developers will be facing? New supply increasingly looks like it will come online in reduced volumes, off time, and off budget. Totally agree on that. I don't think these small guys, I think they're going to really struggle to bring on uranium production. Because if the big boys are struggling and they've got all the experience, they've got all the experienced employees. I mean, these new small companies, they're going to struggle. Totally agree. Energy density like you've never seen. One uranium fuel pellet creates as much energy as 1 ton of coal, 126 US gallons of oil, or 17,000 cubic feet of natural gas. One uranium-sized eraser size. We're talking like the tip of an eraser. Is equal to 1 ton of coal. Palladium, this is not high. He got a long-term view of the support region. We hit the support region, and we're basically bouncing on support. And I do think that we will put a turn in here over time with the palladium price, and then eventually we'll work our way on higher. Natural gas. Look how many times in 25 years natural gas has bounced along the $2 bottom. Inflation in 25 years? Question mark. Nat gas now used in record volumes. Demand higher than ever. Never mind storage surplus at 5%. No one in real world is selling gas at $2 or they deserve to go out of business. But yeah, that natural gas is probably at a low here and will bottom here in the next few months. That's my guess. The Roaring Twenties might be back, says Ed Yardeni, who believes the S&P 500 will hit $5,400 by the end of this year and generate a 30% gain over the next 2 years. He says the Roaring Twenties might be back. In the Roaring Twenties, that was a housing market boom in the beginning of the 20s. And everything basically went up in the mid to late 20s. So coming on down, when normalization of demand comes in, multiples will fall fast for NVIDIA. So it's very 1999-esque. It says once upon a melt up, we've got Cisco in the blue, we've got Intel from 1998 in the black, and then we have NVIDIA in 2022, and they're all roughly the same returns. So that, I mean, those are prior bubbles there for that. Looks like a bubble, walks like a bubble, sounds like a bubble. And that's what I've got for today, guys. So give me a thumb up for the content, subscribe to the channel, and subscribe to the website if you guys like. Use the word discount in the coupon code. And it still looks good for the melt up to occur. So that's what I've got for today. We'll catch you later. This is Finding Value.